All right, this is Chapter 10, Video 2. Let's launch. Okay, so in this video, the learning objectives are going to determine the applicable cost recovery, depreciation, life, method, and convention of tangible personal properties under makers, and then also calculate the deduction allowable under additional special costs rules, 179, bonus, which is actually Code Section 168K, and then, of course, listed property, which is going to require additional disclosures. So the TCJA did make many changes about the way that they recover. Previous to the TCJA, there was a 50% bonus depreciation. They went ahead and they changed that to make it 100% bonus depreciation. And then 179 actually received several changes also. And we'll kind of talk about some of that stuff. So since 1986, businesses calculated a depreciation system using the modified accelerated cost recovery system. Now, here's the thing. I want to stop for 5 seconds and I want to go over this and I want to make sure that we analyze this, because if you take a look at what MAKER stands for, you'll understand a lot about the methods and the way that it goes. And by the way, it is makers, not mockers or makers. I think I've heard makers once or twice. It is makers. That's how we pronounce it. If it's kind of like, pronouncing makers wrong in the tax world is like walking into a financial accounting thing and trying to depreciate land. People are going to look at you. They're going to say some funny stuff about you, okay? You want to call it makers, all right? But let's talk about makers. Modified accelerated cost recovery. Okay, so cost recovery system, I think that's pretty understandable. That's depreciation, okay? That's depreciation. Accelerated. Why accelerated? Why would the IRS want to give you additional deductions? Why would Congress want to give you additional deductions? And if you think about it, there's actually a pretty logical reason for this. And the reason that they actually have for it is, look, if you accelerate the cost depreciation on this, the cost recovery of this, you accelerate the depreciation. It's like I said, depreciation is like a drug. Once you get your first hit, man, you keep wanting it. And so that, there's some people who, all of us, I remember we actually worked on a client and all of a sudden their income jumped up. They didn't understand why. And I said, well, you already depreciated all of your assets. And they said, yeah, but according to my books, I'm still depreciating. I said, yeah, that's for book, not for tax. As a result of which we need to, you need to find other ways to get additional depreciation. So they'd go out and they buy new materials, new machinery, and find other ways in order to be able to get that depreciation. Again, once they got that hit, they wanted to do it going forward. And so that's kind of the way that it happens. And so, and look, Congress isn't stupid. IRS isn't stupid. They know that if you do that, you're going to go out and buy more stuff. And if you do buy more stuff, it keeps the economy going. So there is a national interest sort of motive with this. Now, why is it modified? And that's because prior to 1986, they used to use what they called acres. And then in 1986, they said, look, we don't like the way this is going. We're going to go ahead and we're going to make some modifications to it. And that's when they went to makers, which is going to be how we use this today. Now, to compute makers, you need to know the following: the asset's initial basis, date it was placed in service, applicable depreciation method, the asset's recovery period or its depreciable life, and applicable depreciation conventions. So let's talk about each one of these one by one. Okay, so an asset's initial basis, that's the cost. How much did you pay for the asset? Date it was placed into service. When did you actually place it in service? Not when did you buy it, when did you place it into service? That's important. But if cost happens, if the payment for it actually happens later, and I'm not talking like on an installment method, what I'm talking about is that you don't actually pay for it until later. That can actually delay when you actually put this and have this in. But the date placed in service is usually going to be later than the cost. I mean, let's be honest. Who's going to give you a piece of machinery, especially if it's a couple $100,000 or even $1 million, if they know that they're not getting their cash up front? So they're going to want that. So you're going to probably date, place, and service is going to be the better thing. Applicable depreciation method. So what happens in makers is basically that basically if it is a long-lived asset that is less than 20 years, it's going to be depreciated under the general depreciation system. It's probably going to be double declining balance halfway through, and then it's going to be straight line for the rest of the life of the asset. Now, when it comes to real property, which is usually more than 20 years, then you're going to be depreciating it over straight line over the required recovery period. For example, 39 years for commercial and then 27 and a half for rental real estate. So those are the things that you have to kind of understand. And again, that'll get you to the depreciation life, because once you figure out what kind of an asset it is and what its method is going to be used for, generally then you're going to look at the life. And the way it works, and I don't have my depreciation guide here with me, but basically you're going to have 3-year, 5-year, 7-year, I think 10-year. I think there's a 15-year. There's I think there's a 12-year. Don't get me right on that, but so there's different lives that they actually have. And what they'll do is you can actually pull out, and I have the depreciation guide right here, and the depreciation guide, I can look up what the asset is, and it's going to tell me, hey, this is what you need to do with it. And it's going to be a mixture of things that the IRS has told you, but it's also going to be court cases. Sometimes court, what so if you have a capitalizable expense, is it going to be a 1245 asset or a tangible personal property asset, or is it going to be a 1250 asset, which means it's a real property asset? And there's court cases that go both ways. Very good example, painting. Is painting a 1245 or a 1250 asset? Is it a real real property improvement, or is it a personal property improvement? I've seen court cases go both ways. Which to me, 1250, it should be real property. That's just the way that it kind of looks at for me. But I've seen a couple court cases where it goes 1245. Again, this is where you're going to have to sometimes do some research in order to figure this out. But as you do more and more of this, you're going to realize over time, and you're going to kind of have a sense of it as to whether this needs to be real property or personal property. And then the convention. Now, one of the things we're going to talk about is we're going to talk about half-year conventions, mid-quarter conventions, and mid-month conventions. And each of these different conventions apply to different types of property. So personal property depreciation includes all personal property such as computers, automobiles, furniture, machinery, and other equipment. Basically, if it's movable and it still retains its character and its functional use. Very good example. This microphone that I have right here. If I take this microphone and I move it into my office, is it still a microphone? Yes. If I take it and I move it outside, is it still a microphone? Yes. Can I move it across the street and still use it? Yes. Therefore, this is going to be personal property. Very good example. I have some air conditioning up here. It's an air conditioning duct they have. Can I physically remove that from here, move it into my office, and it still retain its character? The answer is no. I mean, it's still an air conditioning duct, but it's not going to work because I've already taken it out. And so therefore it's going to have some destructive characteristics to it, which means it's not going to be personal property. The depreciation method, like I said, there are three acceptables. The one I was telling you about, the double declining balance, that's the most common. There are some times where you have to use 150, especially under AMT, and then of course there's straight line, and we'll kind of talk a little bit about some of that stuff as we go along. So for financial accounting purposes, asset recovery is based on the taxpayer determined estimated useful life. That's why it's an estimate. You buy a car, you estimate how long you think that car is going to have value to your organization. That's what you do. IRS doesn't let you do that. And the reason why is because it's an estimate. There's too much of a motive to go the way you want it to be, as opposed to something that is equitable across taxpayers. And so the IRS has gone ahead and they put out Rev Proc 8756, which basically says these are the categories that we have. Now, they're general. There's going to be some categories that are not necessarily going to apply to equipment, and that's just because of the nature of how things are. Again, if you use the Rev Proc 8756 and the depreciation guides and with the analysis of the court cases, you're probably going to have a much better successful opportunity to depreciate properly. Once they've determined the appropriate categories, you can use the revenue procedure to identify the recovery period for the asset in that category. I would actually say if you wanted to do something that would be kind of helpful for yourself, go ahead and download 8756. I keep a copy of it actually in my office. I keep a copy of that, the depreciation guides and all that sort of stuff. And sometimes what I'll do is I'll go to RevProc first, and then if I can't figure it out, I'll go to the Quick Finder and figure something else after that. Unless I'm in a real big hurry, then I just jump to the depreciation guide. Normally that'll answer my questions. This is an example of some of the stuff you'll see in 8756, and I'll let you read that on your own. And then this is a recovery period for most common business assets. Again, cars, light trucks, computers, peripheral equipment, 5 years. Office furniture, fixtures, equipment is going to be 7 years. 7 years is actually the default. So if you look at something and you can't figure out anything to be able to put with this, you're probably going to go with the 7-year asset recovery, and then that's going to end up helping you out. Okay, so depreciation conventions. I told you we would be talking about half year, mid-quarter, and mid-month. This is the half year. Half year is a full depreciate. 1/2 of a full depreciation is allowed in the first and last years of the asset's life. So if I buy a piece of equipment on April 1st, or if I buy that piece of equipment on September 1st, doesn't matter. I depreciate it half year. That's, it starts June 31st, or June 30th. I'm sorry, June 31st. Wow. You can tell it's kind of late. This video is being shot kind of late at night, but that's something that you will have to do. And so you want to make sure that you depreciate it accordingly as part of this. So the depreciation, automatically calculates for the half year convention in the purchase and the disposition. Now, let me tell you something. 99% of the time, you're not going to be the one who's doing the calculation of this. What's going to happen is it's going to go into the tax system. You tell them when they bought it based on the best that they have, and then you just say, okay, we're going to depreciate it as of this date. But if you know that the assets weren't all bought at the end of the year, it doesn't really matter when it was bought, because it's going to get depreciated the same way. All right, so if an asset is disposed of before it's fully depreciated, 1/2 of the table is of applicable depreciation is allowed in the year of disposition. So if you sell that asset September 30th, you still only take 1/2 of the year of depreciation on that in the year of disposition. Okay, mid-quarter. So it becomes largely irrelevant post-TCJA. But basically, it's when 40% of qualified property is placed in the last quarter of the business. And so what'll happen is that you'll take, and this is why you got to use tax software for this, guys, because this is easy to miss if you're not paying attention to this. But if you put in there the proper dates when everything is bought, and say you're going to capitalize 15 different assets, and it's hard to figure out whether it's 40% or not, you put it all into the system. It'll calculate it all for you. As I like to say, fat, dumb, and easy, because I'm fat and dumb. I'll tell you that is, fat, dumb, and easy, man. And that's basically what it is. You don't have to really put a whole lot of thought into it. But if you got to do this manually, you have to add up the total of your assets, and then you have to figure out the total of your assets that was bought in the last quarter. If you have more than 40% purchased in the end of the quarter, in the last quarter, you got to switch from half year to mid-quarter convention. And then that's where it's going to be causing some issues. And there's separate tables that are actually out there for that. Calculating depreciation for personal property. Again, determine the appropriate convention. Located on the table, select column that represents the recovery period, and then find the new identifying year of the assets recovery period. You apply the half-year convention, half year in the disposal. Applying the mid-quarter, if you apply mid-quarter and going in, it has to be mid-quarter going out. And so that can be kind of the trick. Again, if you use the software and the software follows this, a lot of that's going to be done automatically. You don't have to really do too much thinking about it. So this is actually the half-year convention. I'm going to talk to you a little bit about this. Hold on one second. I have to blow this up because my screen, it's not big enough. So let's look at this for a minute. Say, for example, I buy a piece of equipment and I bought it for $100,000. And it is 10-year equipment. What's my depreciation in the first year? You're going to take $100,000 and you're going to find the 10-year column, year one, it's 10%. So $100,000 equipment, depreciation is $10,000. That's it. That's all you have to do. These are actually really, really easy tables to use once you get accustomed to them. I actually know some accountants that don't. I pulled out this table on somebody once. They look at me like, "How do you use that thing?" I'm like, "You've been doing taxes for almost 7 years. How do you not know this?" That's because they rely on the computer too much and they don't actually go back to the way these are. These are the tables that you're actually supposed to be using. Doesn't mean, and now, honestly, if you have the software, use the software. Software is there for you to use and make it easy for you. But the thing is that, and if the software is not giving you the right number, you can actually look at this in order to confirm with it. So take that same $100,000 asset. Now it's a 7-year asset. Now how much is it? So it's 14.29%. So it's $14,290. That's it. And in the third year, $17,490. Okay. Now, if you take a look at it and look at the 7-year asset, and you go from year 1, it's 14.29. Year 2 is 24.49. Year 3 is 17.49. Then it goes to 12.49. And then it goes 8.3, 8.2, 8.3. Why does it do that? And the reason why is that after you have depreciated half of the asset, it goes from double declining balance to straight line. And that's how the IRS has calculated this out. Now, here's the thing. If you're using these tables, you don't have to really think about when does it make the switch? How do I figure all that? You don't have to worry about that. The table does it for you. This is why I keep telling people, don't memorize stuff in tax. You don't have to memorize stuff in tax. And I'm sorry I get a little passionate about it, but I have a lot of people who say, oh, I didn't memorize everything in tax. No, you don't. You don't have to memorize anything. All you have to do is follow the blooming table. And I'm sorry, maybe it's because I'm a little tired, but I'm going to tell you something right now, folks. Tax is easy. Once you figure this stuff out, depreciation method is actually pretty easy in that sense. All right. So this is if you get to 15-year assets or 20-year assets, and this is in years 11 through 21, of course. These are the tables that they actually use in your book. They're a little easier to read, in my personal opinion. Just because of the color and all that sort of stuff. So I would actually go ahead and use these tables. Generally, when you have the test, the test is going to be open book, so you don't have to worry about that, just like the first test was. You might want to make sure that you have these thumbnailed, because if I ask you to calculate the depreciation for, say I give you a thing and I say, okay, this is, this, and this is the mid-quarter stuff, by the way. Obviously you're looking at it, but if I tell you mid-quarter, it was placed into service in quarter number, we'll say quarter 1, because the particular asset you have wasn't the trigger for the 40%, but it was also an asset. But I could say it's a $10,000 asset placed into service. It's a 5-year asset, mid-quarter, quarter 1. What is the depreciation at year 4? And you should be able to look at that and see 11.01%. So you take 10,000 times 11.01. That's the depreciation for that year. Again, it's easy. You don't have to think too much about it. This is the mid-quarter for full year's depreciation in a year of disposition. Again, if you dispose of it in quarter number 3, you're going to take 62% of the depreciation that it's supposed to have had for that year. And so that's how this kind of works out. I don't think I haven't finished writing the test yet for number 2 at the time of making this video, but I don't think I'm going to be asking you about things like disposition in mid-quarter. You want to know it though. You really want to know this, and it's kind of important. Maybe I'll throw a question in. I don't know. We'll talk about it in the midterm review. So real property, you're going to use the mid-month convention, depreciating using straight line method. Real property is stupid easy. All you have to do is it residential? Yes. 27.5 years. Non-residential commercial, 39 years. Done. And then the easy part about this is, actually the hard part is year of placing into service, year of disposition. But if I'm calculating, if I want to figure out what the annual rate is on a non-residential commercial building, that's say, $390,000, I'm going to divide it by 39 and, you get $10,000. That's the way this works. You don't have to, again, it's stupid easy. You don't have to worry about this. As long as you figure that stuff out. Now, there are depreciation tables for this. They're a little different because obviously they're not going to list out all 39 years. That would just be a waste of paper, but they'll tell you year 1, this, year 2 through 38, this, and then year 39 is this. Okay, so immediate expensing. This is, it's commonly referred to as 179 or immediate expensing election. I'm going to talk a little bit about 179 and bonus depreciation after we've covered both topics, but the immediate expensing, basically, there's limits on it. Generally, this does not apply to very large companies. It's usually smaller organizations that get to be able to do this, and there's going to be limits because it's a taxable income limit. So obviously, if you have a huge taxable income, you can't do this. There is a property limitation. You can't put in too much property, and that's why, like, Coca-Cola can't do this. They put too much property in every year and they pull so much out. It's not that thing. And then you also can choose the assets that you want to immediately expense. All right, so bonus depreciation is used to stimulate the economy. And actually, you'll notice that bonus depreciation numbers usually get jacked up right around the recession periods. Very common. Right now, it's at 100%. Actually, this was the first time that we weren't in a deep recession before they jacked it up to 100%. That was actually kind of a little different than they've done in the past. But it's used to stimulate the economy, and policymakers occasionally implement this in order to get that going. It's 100% for assets placed into service between September 27th of 17 and then September 31st of 2022. After that, they're going to probably phase this out. And again, who knows what happens in 2022? We may have a market crash, and if we had a market crash at that point, we may have to go back to 100% depreciation in order to get the economy going again. So, again, bonus depreciation will be the primary way to depreciate qualified assets for most businesses. I take issue with that. I think that we have to be smarter about it. And again, when we get past all of this, I'll kind of talk about that. Businesses may elect out of bonus depreciation, and there are certain times that you're going to want to do that as opposed to others. So before I talk about listed property, let me talk about bonus depreciation versus 168, subsection K. That is your bonus depreciation. All right. So when you're taking a look at whether you want to do 179 or if you want to do code section 168K, what'll happen is that most tax systems are going to automatically select bonus depreciation for you. That may not be the best way to go. I actually would highly recommend that you examine whether you want to do that or 179. If you are living in the state of Virginia and your business is in the state of Virginia, you're probably going to want to do 179. Here's why. Bonus depreciation is not allowed at state levels. Okay. So the state of Virginia, state of Maryland, District of Columbia does not allow for bonus depreciation. You take bonus depreciation, you're going to be regularly depreciating the rest of your assets over their lives. Okay. If you qualify for 179, you want to do 179 because you get equal treatment on the state return and the federal return in the state of Virginia. Maryland and DC are a little different. So 179 used to have limits of $25,000 of expensing in 1 year. And they've retained that, and they've kept that going forward. So if you get some assets that you're going to go ahead and you're going to want to do some immediate expensing on, you're going to want to start examining this. You can bonus some things and 179 others. I mean, that's perfectly all right. But you want to make sure that you're taking advantage of that 179 deduction at the state level, if at all possible. Now, if you're in a state that doesn't have an income tax, don't even worry about it. Do a bonus and move on. But sometimes it may end up doing better to do the immediate expensing versus the 168. The bad news is the tax system doesn't automatically, it doesn't pop up. Do you want to do 179 or 168? You have to think. You have to bring your brain power to this. And that's going to be kind of important for you. And I've seen a lot of times in my office, I've seen it. I've also seen it when I've worked at other practices where people just automatically, we'll just bonus everything out. Why? I mean, the person's in Virginia. They, use 179. He's going to be able to write everything off both at the state and federal level. Why not go ahead and do that? And I think that's very important. Okay, listed property. Listed property are basically assets that are used for personal and business uses. So, for example, the biggest one is cars. Cars used to be cell phones. Now that cell phones, so much of it's unlimited. They've removed that. But cars and computers. If you have a very, very small business, a one-man operation, you have a computer, they're going to want you to put it as listed property. And you have to delineate, is it business use? Is it personal use? And then you've got to be able to split that out. Now, with cars, you're going to do that by mileage. Things like computers, usually the way I've done it, I've used hard drive space. So what I've done at the end of the year is I take screenshots of all my hard drive, files to show this is all business, this is all personal. Therefore, my computer is, 80% business. I only had to do this for like 2 years because, in the beginning of my business, I was actually working in my basement. But, towards later on, it actually made more sense, after I moved out. Now my computer is no longer located in my house. It's actually located here in my offices. I don't have to worry about this. It's not listed property anymore. So this is something you might want to take a look at. It could have an effect, and you want to go with that. Let's see. All right. So if business drops below 50%, you're going to have to use the following steps to calculate depreciation. I'm going to let you read this. I'm not going to read the slide for you. And there's not really anything on there that strikes me as weird. It's a process. Follow the checklist. You're going to do fine. Luxury automobiles. So if you want to take, how much depreciation can I take in the first year of luxury automobiles? Luxury automobiles actually have a depreciation limit because, what they don't want happening is they don't want you running out buying a Jaguar. And, and I've seen real estate agents do. They're like, I have to be driving the best car around because if they don't see I drive a good car, they're not going to trust me. Okay, well, I get it. So if you're going to go out and buy a BMW 7 Series, you're not going to be able to write it off your first year. And there's actually some people who have actually thought that. And then they come to me and I'm like, nope, can't do it. So in 2020, these are actually the limits. And you notice that it says the first year is $10,000. And then the second year is $16,000. And then the third year is $9,000. And every year after that, it's $5,760. Now, if you do bonus depreciation, you're allowed to take an additional $8,000 off of all that, both in 2020, 19, 18, and then 17. Okay, so that's very important to take into consideration. And that's all I got to say, folks. I mean, this is the end of the slide. It's a real long one. I apologize for that. But we're chugging along, and I hope to see you, or not hope, I look forward to seeing you in the next video.